Over the past 2 years, REIT share prices crashed even as most of them kept hiking their dividends, and as a result, REIT dividend yields are today historically high. It's not uncommon to find high-quality REITs offering an 8% dividend yield that's even paid on a monthly basis. As a result, it's today a lot more attainable than it was just a few years ago to build sizable income streams by investing in REITs. Hey everyone, this is Jussi. I'm a CFA charter holder but not a financial advisor, so make sure to do your own research. I run a small investment firm that specializes in REIT investing, and today's video I want to talk to you about 5 REITs that pay me more than $1,000 per month. The blended average dividend yield of these 5 REITs is about 7%, and what this means is that if you want to earn $1,000 per month, you will need to invest roughly $170,000. Before I go into the first REIT, if you want to support this channel, it will really help me a lot if you click the subscribe button as well as the like button. That helps me grow my audience, so thank you so much in advance. The first REIT I want to discuss here is called EPRA Properties. Its ticker symbol is EPR. This is one of my largest REIT investments. I bought a lot of it during the COVID lows, but I keep accumulating more of it today. This is an investment grade rated REIT that specializes in experiential net lease properties such as golf complexes, ski resorts, hot springs, amusement parks, and even movie theaters. Most of its investments are structured as triple net lease investments, which differ from your traditional property investments in that the lease is structured in a way that's very favorable to the landlord. Typically, the lease term will be really long at about 10 to 15 years initially, and then include several 5-year extensions, and so the rental income is highly consistent and predictable. Then secondly, the rent will be predetermined for the entire lease term and include typically annual rent escalations of about 2%. And then thirdly, typically the tenant will be responsible for all property expenses, including even the property taxes, insurance, and also the maintenance of the property. Therefore, the returns of net lease properties are typically very consistent, and EPR Properties has a multi-decade track record of significant market outperformance by following this unique investment strategy. And it's not just EPR, many of its other net lease peers like NAREIT, WP Carey, Realty Income, which is probably the most famous REITs, they all have long track records of significant outperformance. However, today EPR is very heavily discounted. It's by far the cheapest net lease REIT out there, trading at just around 8.5 times cash flow and an 8% dividend yield. I believe that the reason why it's so discounted is because it suffered a lot during the pandemic and it continues to hurt its market sentiment today. The pandemic was the worst possible crisis for a REIT like EPR Properties because during a period of time, the tenants of its experiential properties couldn't properly operate their businesses, and so they were failing to pay their rent. However, the good news here is that we've moved past the pandemic. The businesses of EPR's tenants have recovered. They've now resumed their rent payments, and this year EPR is expecting to earn record levels of cash flow. Even the weakest link in its portfolio, which are the movie theaters, have now seen their rent coverage ratios recover to the levels of 2019, so pre-COVID levels. The rent coverage ratios of the rest of its portfolio is actually way above pre-pandemic levels, so overall the average rent coverage of the portfolio is now at near record highs. Today the REIT has about 12 years left on its leases on average. They also include about 2% annual rent escalations, and so even if we go into a recession tomorrow, that shouldn't have any major impact on the REIT. Despite that, the REIT is heavily discounted. It's offering an 8% dividend yield, and that's with a very conservative payout ratio of right around 70%. What's even better is that the REIT is paying you on a monthly basis, and that should help you to stay patient while you wait for recovery in its share price. Then the second REIT I want to discuss is called Northview Residential REIT. This is one of my newest residential investments. This is a Canadian apartment REIT that's offering a near 8% dividend yield, also paid on a monthly basis. The reason why its dividend yield is so high is because the share price of the company is heavily discounted. It's currently trading at a roughly 35% discount to its net asset value, which is the lowest valuation among Canadian apartment REITs. I think that there are two main reasons why the stock of this REIT is so heavily discounted. The first reason is that the REIT is a bit more heavily leveraged than its peers. Its loan to value is 65%, which may seem very high, but here you need to take into account that this REIT is focusing on higher cap rate residential properties in more rural markets, and so if you look at its leverage relative to its cash flow, it's actually not materially different from its close peers. Moreover, the REIT also retains about 30% of its cash flow, and it's using all of this cash now to pay back debt, so this should help them bring back down their leverage gradually over the coming years. And then the second reason is that until recently, Northview Residential was actually a much smaller, externally managed closed-end fund. It wasn't structured as a REIT, it was structured as a closed-end fund, and so because of these reasons, it's quite understandable that there wasn't much interest for this vehicle. However, just recently they went through a transformation they internalized their management, they restructured as a REIT, and they went through a major recapitalization transaction that lowered their leverage, it right-sized their dividend, and it massively expanded their scale. I think that it will take some time for the market to change its perception of the company, but now as they gradually pay off leverage and prove the market wrong, I think that eventually it's going to reprice at closer to its net asset value, which could unlock up to 30% upside potential. While you wait, you're earning a new 8% dividend yield, which is the highest yield among apartment REITs in North America. Before I go into the third REIT, I wanted to remind you that you can access my entire real money REIT portfolio by joining my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link to it in the description of this video. The third REIT that I hold in this portfolio is Gladstone Commercial, and I'm here referring to its Series O preferred equity and not its common equity. Gladstone Commercial is a small net lease REIT that owns primarily industrial properties, but there are a few reasons why I'm not interested in its common equity. The first reason is that it's externally managed, which comes with some conflicts of interest. I've discussed this topic in previous videos. I'll link to one in the description if you want to learn more. Then the second reason is that they generate about a third of their revenue from single-tenant office buildings that I expect to perform poorly over the coming years. And then the third reason is that once you take this into account, the fact that their office buildings are likely going to perform poorly, I think that they have a bit too much leverage, and that makes me uncomfortable holding the common equity. However, I think that the preferred equity is a lot safer because it's only a small slice of their balance sheet and it's enjoying the buffer of the common equity, which will absorb any of the losses coming from the office buildings, and yet the preferred equity is just as heavily discounted. Today, the dividend yield is nearly 8%, it's paid on a monthly basis, and the discount to par is also about 25%, so eventually as interest rates return to lower levels, the REIT keep reinforcing its balance sheet. It also pays off some debt. I think it's going to re-rate at closer to its par, which could unlock 20 to 30% upside potential. Just recently, the REIT also cut its common dividend, which is actually beneficial to the preferred shareholder because it means that they will retain more cash flow in-house to pay off debt. This provides more margin of safety for the preferred shareholders, and therefore I think that the preferred dividend is safe and sustainable. Then the fourth REIT I've already discussed on this channel is called BSR REIT. Its ticker symbol is HOM.U in Canada and BSRTF in the US. This is the lowest yielding REIT on this list. Its dividend yield is only 4.5%, but here you need to keep in mind that if investing in lower cap rate, faster growing properties, these are mostly apartment communities in Texan markets. And secondly, the yield is so low because they retain 40% of their cash flow in-house to buy back shares. What's uniquely attractive about this REIT is that it's almost exclusively invested in the Texan Triangle, which is expected to enjoy very rapid population and job growth over the long run. However, today these markets are a bit overbuilt, and as a result the rents of BSR are stagnating, and that's hurting its market sentiment. Right now its stock is priced at a roughly 35% discount to its net asset value, about 8 times its cash flow, which is a historically low valuation for a REIT like BSR. The management is very well aligned with shareholders, and so they are using this opportunity to buy back shares to create value for long-term oriented shareholders. While you wait, you earn a monthly 4.5% dividend yield, and what's attractive about this dividend is that the management is classifying it as return of capital in most cases, and as a result the taxation is fully deferred. Before I go into the fifth and final REIT, I also wanted to let you know that I'm planning to film separate videos that are much more detailed on each of these opportunities, so if you don't want to miss any of those, make sure to click the subscribe button below. And then the fifth REIT is Canadian Net REIT. Its ticker symbol is NET.UN. This is a small cap net lease REIT that's operating in Canada. I've previously described it as a small Canadian realty income. It has built a net lease portfolio that focuses on very defensive categories like grocery stores, convenience stores, and quick service restaurants. Most of its tenants have an investment grade rating, and unique to its leases is also that it enjoys some CPI rent adjustments, which should provide better inflation protection compared to its peers in the US. What's more is that this REIT has one of the best track records of any REITs worldwide. It has managed to grow its FFO per share and its dividend per share at a very rapid pace over the past decade. But despite that, the stock is today discounted. It's trading at around 8 times its cash flow, or FFO as we say in the REIT sector. Its dividend yield is approaching 7%, paid on a monthly basis, and really well covered with a low payout ratio of below 60%. So with these 5 examples, you can clearly see that now is a great time to build income streams by investing in REITs. Dividend yields are historically high because valuations are so low. And so if you want to learn more about these investment opportunities, you can join my REIT newsletter for a 2-week free trial. It will give you instant access to my entire portfolio, all my transactions in real time, a course on REIT investing, and much more. As I've said before, this is a real 2-week free trial, so you won't be charged anything in the first 14 days. You can join, you can stay for 10 days, and you can then cancel if it's not for you. That's perfectly fine with me, and you won't be charged a penny. And then finally, once more, if you enjoy this type of content, it will really help me a lot if you click the subscribe button as well as the like button. It doesn't cost you anything, but it helps me a lot to grow this channel, and I appreciate it a lot. So thank you very much in advance. I'll see you at my next one. Bye bye.